So, welcome to the series on YouTube called Unlocking the Secrets of Property Investment. In this lesson, we're going to look at the power of the internal rate of return, the IRR, and how it can be used to compare and evaluate different properties with other classes of investment and with other properties in different classes. Now, this topic to some of you may sound boring, but I assure you that this is the foundation of the second biggest investment secret that absolutely no financial planner or financial institution will tell you. And that is today's lesson, which is called The Power of the IRR. If you're new to this channel, I'm Dreyer. I'm the founder of the Wealth Created Method, where we help entrepreneurs and investors to create, to grow, and to protect their wealth by applying a very special strategy, the Wealth Creator strategy. And I'm here today to share with you some valuable property investment tips that I've successfully applied over the last 40 years as a property investor. Now, when it comes to investing in property, it's important to know how to compare property to other property or to other classes of investments. And this is where the internal rate or the IRR really comes in. Now, the IRR is a key metric that allows you to measure the performance of investment over a period of time. But it's not just about having the right, let's call it, tool in order to be able to make this comparison. It's also about having the right attitudes and the right mindset. Now, when I look at people and the way that they approach investments, the majority of people will not invest in themselves and their personal development. They just want the techniques. And I'm going to give you a technique in a strategy right now, which is called the IRR. But that strategy is useless if you do not have the right mindset to implement and to make sure that you master that. So without the right mindset, you're not going to apply the right tools. So make sure that your reasons for why you want to invest in property. Now, this is not what we're going to do in this lesson. I've got other places where I can help you with that, but make sure that you understand your reason why and what property can bring to you. So this is on the IRR. And in order to become a successful property investor, it takes self-investment, both in terms of time as well as money. Now, I've seen the power of property investments firsthand, and I'm here to share that knowledge with you. I discovered this basically in 1987. At that point in time, I was 30 years old. Today, I'm 65. But because of this knowledge and because the IRR played a huge role in this success story, I was in a position to be financially free because of property at the age of 37. And this is one of the reasons why I'd like to share with you this information. So if you haven't done so already, make sure to tune into my YouTube channel for more tips and insights on how to make the most of your property investments. Now, what sets property investments apart from any other investment, let's call it option, I think is definitely the emotional connection that it can bring. But we've also seen that the financial side, the sums, are crucial. So we first need to get that in place. And once that is in place, then we can tap into that emotion, because that is what's going to help us to keep on growing our portfolio. Now, I can tell you that owning a piece of property can be incredible, rewarding, both financially as well as emotionally. That feeling of pride and accomplishment that comes from finding that right property, that little treasure, that jewel, that this thing is going to help you to get to financial freedom in a very short time. And then to be able to see how that manifests and how that becomes a reality, and how with that one property, and because of that property, you can get to a point where you are financially free. In my case, at the age of 37. That is powerful, my friend. So that's why I believe in the power of property investment. The moment that you combine the two, where you can measure the process, improve the process, but at the same time get the emotional rewards where you can travel and where you know that you can do what you want to do, when you want to do it, how you want to do it, where you want to do it, with whom you want to do it. We call it financial freedom. It is simply amazing. So it's not just about the numbers, although today is more about the numbers. It's about that emotional fulfillment that comes with owning a property. And that's something that unfortunately can't be measured by any metric. Now, there are several advantages. Let's get into the lesson. to use the IRR and to compare different properties and any other class of investment with one another. So the IRR, as an example, provide a consistent method to evaluate the performance of different properties, allowing you to accurately make a fair comparison. So I can literally compare a property in South Africa to a property in the United States. But I can also compare a property in South Africa, a residential property, a duplex, to a simplex. I can also use the same calculation in order to compare that to an industrial property, a commercial property. It's amazing, and this is only the basis of what you need to understand. Another thing is that the time value of money is brought into the IRR, which means it considers the impact of inflation as well as what's going to happen with the rent that you're going to receive. That rent yearly will increase with inflation, and it brings all of that in. It's an incredible tool that you can use. Another thing is that I can check out the overall performance. So it allows me to evaluate that performance over its entire life, giving you a more comprehensive understanding of the potential return of that investment. I can also do my risk assessment or a part of my risk assessment with this tool. So the IRR can be used to compare the potential return on different properties and different classes of properties with different classes of investment, allowing you to assess the level of risk that is involved. For example, with a retirement annuity, pension fund, provident fund, people will tell you, yeah, but there's a tax benefit and stuff like that. So I can use this to see the bottom line. And it's really powerful. And I suggest that you put in the time and the effort to find out a little bit more about. And you could find it, by the way, on any Excel spreadsheet. So it's not difficult. But the way that we do it, of course, is not the normal way, because there we start bringing in all the risk and the skills to offset the risk. Now, another reason and advantage why I use the IRR is it helps me to make better decisions, comparing different properties with other classes of investment by using the IRR. Now, with this knowledge that you've got based on the outcome of that sum, you can choose to invest in what is most likely going to deliver the highest return on investment. You know, if you compare two investments and the one is going to give you an IRR of, let's say, 8%, and another one is going to give you an IRR of 80%, then the 80% will be a better investment than the 8%. Most people don't know how to do that calculation, and therefore they don't know that they've got options. Now, I'm using the IRR as a basis to do what we call a benchmark. So in the masterclass, I'm going to give you a tool that you can use, and I'm going to give you training on that tool, and that is the Financial Freedom Planner. And a part of that is to determine your own financial freedom growth rate. Now, that financial freedom growth rate simply means that it takes into consideration how much money you're going to invest over what period of time and what growth you must get in order to get to your goal. Once you've got that, your financial freedom growth rate, that then becomes your benchmark. And now any investment, not only property, any class of investment anywhere in the world, I can calculate what is the IRR. And in property, the first line is the IRR. So the moment that I've got my benchmark, now I can calculate the IGR, my investment growth rate. Now in property, you can, it's not the right way to do it, but you can use the IRR as your IGR. Of course, it's a little bit more advanced than this, but in general, it's going to give you a quick indication of what to work. Now, if your IRR in property is lower than your financial freedom growth, that property will never be able to help you to get to your financial freedom. In other words, it's not going to help you to get there. And therefore, don't waste time on these. So it's a very quick way to select the losers from the winners in a matter of minutes. Now, another thing of the IRR is very flexible. So I can use it to compare different property sizes with different types of property, with different locations anywhere in the world. And this is making it a very versatile tool for evaluating literally a very wide range of investments, not only, as I've said, property. Now, tax plays a huge role, especially when you start making serious money. So in the IRR, you can build it in so that it takes into consideration the tax implication and therefore allows you to compare the after-tax return on different properties, but not only different properties. Now I'm sitting with a situation where I can compare the after-tax return on a retirement annuity, because a lot of agents and brokers out there are going to tell you that a retirement annuity is a great investment. And to some people it may be. But the chances are that if you're a master property investor, the chances are 99.9999% that you'll never take out a retirement annuity. When I discovered this way back in 87, I stopped all my retirement annuities, all my unit trusts, all my endowment policies, and I went into property. Now, of course, there are more advanced strategies that you can use, like the wealth creator strategy that I'll tell you a little bit later on. But for the average person, the IRR is an incredible tool. And then also in the Property Pro investment system, I'm using a ranking system. So you feed like 100 properties or 50 properties into the system and immediately ranks you from the best to the worst. You can also draw a line in terms of your benchmark and say these properties, which by the way will be 95 to 98% of the time, these properties I'm not going to look at because I'm going to waste my time. And those properties are the properties that's going to cost you the time, the effort, the blood, sweat, and tears, because it takes a lot of time to really evaluate property any other way. And especially when you want to do the due diligence and stuff like that. Now, another reason, I can't stop giving you more and more reasons, but another one is the long-term perspective. It measures performance, which is really useful when you start evaluating different properties. Now, I can have a look at what has happened really over the last year, 5 year, 10 year, 20 years with properties that I've got in terms of the real growth by using this tool. But then I can also say, but when I buy a brand new property today, what is the expectation of over the next 5, 10, and 20 years? But then I can use an existing property to see the break-even point. Now, that is the moment that my IGR dips below my FFGR. So in property, you'll find it almost always, if you bought the right property, that in the beginning, your IRR is going to be very high and then it starts to drop. So there will come a time in every single property investment where you have to do something about that property, because otherwise you're not going to continue getting the growth. We call it the ceiling of complexity, by the way, and I'm not going to go into it now. But that is the time that you either have to use another technique, either the roll-in or the stepping up technique, in order to maintain that kind of growth. So it allows you to see the property, how it's going to perform over a period of time, and when to do what with that specific property in order to maintain that growth. Now, one thing that perhaps not many people know about comparing the IRR and comparing properties is that you can use the IRR not only to compare properties, but any investment, like I've said. And then also how long to hold that property, as well as when to take the next action step on that property. And there are not a lot of other tools that can help you in that process. And this can be very useful when evaluating the long-term potential of different properties as investments. Now, another thing maybe that is not widely known is that the IRR can be used to compare properties with different financial structures. What do I mean with that? For example, I want to buy a property and I've got the cash. Is it better for me to buy cash, or do I need to take out a bond or a mortgage? And if I take out a mortgage, how big should that mortgage be? Now, with IRR, you simply build one column that says no deposit, another column 100% deposit, and then as many variations as you 10%, 20%, 50% deposit. And then do the calculation, copy and paste, and immediately you get the answer. It's that simple. Now, of course, this is not 100% the truth, because you have to take all the risk factors into consideration and the skills to offset those risk factors. But in general, this is really an incredible tool to be able to use. Now, this can be very helpful when evaluating the impact of say, for example, I want to invest in my personal name, and it's a question that I'm getting on a regular basis. Should I do it in my personal name? Should I do it in a trust? Should I buy this property in a company? And all of that, those answers, if you've got the right tool, and the IRR should be part of that tool at least, you're going to get the answers in order to make an informed decision. Now, it's also important to note that the IRS got some limitations. For example, I'm not going to get really deep into this. But as an example, it assumes that you've got a constant cash flow. Now, we know that with property, that is not the case, but that's the assumption that you make. Now, again, once you understand and once you've got the skill, I'm teaching you how to offset that and how to do that correct and how to turn the IRR into the IGR. But it gives you the basics, and that is one of the biggest downfalls of the IRR. Also, it does not take into consideration what do you do with the surplus money the moment that you started making a positive cash flow, which in most cases my students are getting in a very short time span, simply because we like to buy infinite properties, and then how to structure those. And therefore, the IRR should be used in conjunction with other tools like the Property Pro investment system. So without the IRR, it is impossible to make any investment decision. And yet, this is what 95 to 98% of all people are doing currently. They get emotionally involved first instead of do the sums first. And the moment that you get emotionally invested first, you've got a serious problem because it's going to cost you financially your freedom. So don't become emotionally invested before you've done the sums, because that is the main reason why people will not get out of the rat race. And again, in the masterclass, I'm going to take you through the process step by step so that you can follow me and see where you've gone wrong, where you are going wrong, and what to do about that. Now, if you want to receive more tips and strategies like this one, it's actually going to be very simple and easy. All you have to do is to like, subscribe, and hit that bell icon so that I can share even more valuable insights and strategies on how to make the most of your property investments. Now, if you are ready to take your property investments to the next level and you want to accelerate that process, in other words, accelerate the growth and your personal growth with the least amount of risk, then I'd love to invite you to join me for an exclusive property masterclass where I'll be sharing with you the strategy and the blueprints on how I'm currently busy with this challenge. And this is by applying the wealth creator strategy that I mentioned right in the beginning. And that is to turn just 100 Rand into a property portfolio to the value of more than 10 million over a 5-year period by applying this strategy. So this is mind-boggling. And even if it's just for this, make sure that you attend that masterclass. It is really going to be the best investment that you'll ever make. And let's face it, there's not a lot of people that can take only 100 Rand and turn it into 10 million property portfolio in less than 5 years. So this masterclass, my friend, is really the opportunity to learn directly from myself, my team, what we've done, what we are busy with, and then directly from my students that have implemented this that we are talking about. So if you want to succeed in property, I think it's one of the things that you owe to yourself to make sure that you attend. So whatever you do, don't miss out. Now, sign up for that masterclass. You're going to find the link somewhere in the description area. If it's in YouTube, or maybe it's an ad, or maybe it's somewhere on this page, find that link and make sure. Otherwise, contact the office. Thank you so much for watching. And if you've got any questions regarding property investments, please put that question in the comment section. Maybe I can use it at a later stage to make another lesson from that. And then also, if you've got a comment, please comment, maybe even share that. And then thank you so much for your time, and I'll see you then in the next one.